In addition to issuing its annual financial statements, companies that are publicly traded are required to prepare what's called an annual report. And the financial statements are a portion of the annual report, but there are additional sections that also give investors information. The first is the management discussion and analysis, then there's a report on internal controls, and then the fairness of the financial statements. The management discussion and analysis, often referred to as the MD&A section, this is where the management is making representations about significant things that may have occurred within the company that are of importance to potential investors. They may talk about liquidity, any risk exposure. If there are transactions that are not appearing, they're sort of off balance sheet transactions, although there have been attempts to sort of reduce those to the extent possible. But to the extent that there are, this is where management has the opportunity to give a narrative. What are our accounting practices? What do we use for, inventory? Are we using LIFO, FIFO, whatever it is? So, but this is a narrative where management can describe its operations and what's happening. Beyond that, and as a result of the Sarbanes-Oxley Act of 2002, the annual report also has to include a report on internal controls. So are there internal controls that present material weaknesses, significant deficiencies in internal controls? How well are we doing to ensure that there are safeguards on the company's assets? And so management has to give an assessment over how well they are doing to safeguard company assets. And then the job of the internal auditors is to go in and double check and make sure that management's representation about the adequacy of internal controls is in fact accurate. Okay. Then we get to the report on the fairness of financial statements. And this is what made external accountants really an indispensable part of corporate America, is that publicly traded companies are now required to have outside independent auditors come in every year and look at their financial statements, conduct an audit, and then give a report. So they, again, not only report on the adequacy of internal controls, but the fair presentation of the financial statements. And then they will issue an opinion about the fair representation, fair and faithful representation of these financial statements. They will issue either an unmodified opinion, otherwise known as a clear opinion, meaning that we agree the company has fairly represented these transactions in their financial statements, or they will have some other kind of an opinion, which would be a red flag. So anything other than an unmodified opinion is a problem. So if you've got a modified opinion, that means that the accountant isn't able to, with a straight face, say these financial statements look like they fairly represent the company's operations. There are some additional slides that go through the appendix about unusual items on the income statement, things of that nature. I'm not going to really spend a lot of time on this because it really goes well beyond the scope of this. But if you're looking at a company's annual report and there you see things that are additional that we haven't talked about, there are additional disclosures that are required to be made. If there are unusual items that affect the current period income statement or any prior periods, those have to be disclosed. Any discontinued operations or operations which we believe we are about to, which we have deemed we intend to discontinue, we need to report those and separate those out because we don't want to commingle the items from continuing operations with the line items from operations that we are intending to no longer engage in going forward. And again, it talks about what constitutes a discontinuing operation and strategic shift, and just I'm not going to hold you accountable for any of that, but just wanted to show you how we would separate out on an income statement any gain or loss that was related to discontinued operations. And that we would report earnings per share on the discontinued operations separate. And I am not going to go into fair value, so that concludes Chapter 16.